Hi everyone, my name is Debashish Ray. I am a D365 F&O SCM consultant with Walkerscott. This presentation will delve into the essential concepts of inventory costing in D365 F&O. I will talk about various valuation methods available to use in the F&O system. I will also show you how various inventory transactions occur under each of these costing models. Few inventory related KPIs, and we'll conclude with talking about some common challenges and the best practices that we must follow in D365 F&O inventory costing. All right, so I will now take you through some basic costing concepts in the next few slides. Costs influence pricing strategies to overall profitability for many organizations, and they often feel that it's like a heavy weight to carry. Some costs are visible, measurable, and relatively straightforward to track, like materials, components, and direct labor. But few others are less apparent, like the indirect costs, such as overheads, marketing, or R&D expenses. So businesses that actively manage their costs well put themselves in a stronger position to improve their business performance. Now let's zoom into one of the key cost drivers for most businesses, which is inventory. The cost of your items directly impacts your profit and loss statement through your cost of goods sold or COGS entry. Costs also drive the value of your inventory, which is reported on the balance sheet. If your costs are high, but your sales prices aren't aligned, you risk having thin margins or even losses. That's why accurately capturing and managing costs is absolutely important. And this is where D365 FO costing configurations becomes critical. The way system is set up dictates how costs are captured and applied in procuring materials, producing goods, or selling inventory, which then ultimately determines the accuracy of your financial outcomes. Let's first understand what happens from a costings perspective when we purchase goods in D365 FO. Value of inventory gets accrued in when we take possession of the goods. We begin by creating a purchase order and receiving goods against it. The system recognizes that we now have inventory on hand. At this stage, the inventory value is accrued and appears on the balance sheet as goods received not invoiced entry. This creates a liability that we owe money to the supplier. The purchase price of the goods at the time of receipt could become the initial cost basis for valuing that inventory. However, when the purchase order is invoiced and the final cost is captured, which could include any other charges like logistics costs or inventory, the inventory value is then finalized and it moves into the cost of purchase category. The value will remain physically and financially into our possession until we sell these items. Now let's look at what happens when we sell goods from a costings perspective. Once the goods are shipped to the customer against a sales order, the value of inventory in a balance sheet is immediately reduced through this transaction. At this point, the system records the transaction in a shipped not invoice account. This means the goods have physically left, but the sales invoice and therefore the revenue hasn't been posted yet. Finally, when the customer invoice is generated, the system updates the cost of goods sold. This is when the cost is officially recognized in the P&L, aligning with the revenue from the sale. This cycle is known as a complete turnover of inventory. From costings perspective, it is important to understand the concepts of matching of sales or issue costs with the purchase or receipt costs. Every inventory transaction in D365 FO is classified as one or the other. A receipt is any transaction that increases our on-hand inventory. Every time we receive inventory, it comes with an associated cost, such as purchase price, freight, or any other charges. These costs get stored in the system as part of the inventory's value. Issue is any transaction that decreases our on-hand inventory, for example, selling to a customer or consuming in a production operation. Costs that we incur when receiving goods are denoted by upward arrows in the diagram, which show purchases coming in at different costs over time. This further determine the costs that you recognize when you issue those goods, as denoted by the downward arrows in the diagram. The question mark represents the cost determination process, and this is the heart of cost calculation logic in D365 FO, where the inventory valuation methods such as FIFO, weighted average, standard cost come into picture. That was all about some basic terminologies and costing concepts in general. Now I will talk about some important configurations that control costing behavior in D365 FO. Configuration of item model group and its association with the inventory item is main driver of the costing behavior in the system. The primary function of the item model group is to determine the inventory valuation method that controls how items will be costed when issued. We'll talk more about this later. An inventory policy of stocked or non-stock products can be applied within the item model group. Stock products are handled in inventory and generate inventory transactions, while non-stock products do not. Stock products are included for inventory valuations, but non-stock products are not posted to inventory. nor held in the balance sheet. Include physical value controls whether physically received but not yet invoiced transactions should be included in the calculation of cost for an item. If enabled, any product receipts will count towards the calculated cost and inventory value, even before vendor invoice is posted. And if this is not enabled, the system will only use financially updated or invoiced transactions for cost calculations. Fixed receipt price is used when you want to simulate a standard cost like behavior for specific items without fully using the standard cost model. If this is enabled, system will always value purchase receipts at the item's fixed cost and post any differences between the fixed cost and the actual purchase price to a variance account. Post physical or financial inventory to ledger. Physical posting refers to creating ledger entries for goods receipts and issues, and financial posting refers to the final ledger impact at purchase or sales invoicing. In most cases, both are enabled so that both the provisional value at receipt and as well as the final settlement are reflected in the GL. When accrue liability on product receipt is enabled, posting a product receipt for a purchase order will create a goods received not invoiced entry in the general ledger. This creates an accrued liability at the time of receipt. While on sales side, if post to deferred revenue account is enabled, estimated revenue for the delivered quantity is posted upon sales delivery note updates. Physical or financial negative inventory refers to situations where system allows stock or value to drop below zero. In case of physical negative inventory, it means system will permit issues even when there are no physical stock available and the quantity goes negative on hand until receipts are updated. Financial negative inventory allows financial updates of issue transactions without financially updated receipt costs or values. So quickly summarizing on a few key points in best practices. Include physical values used only for periodic inventory models and not for any moving averages or perpetual inventory models. It's more relevant when there is a small time gap between receiving and invoicing. So a best practice would be to keep it disabled for avoiding any cost distortions. Fixed receipt price locks the cost at the receipt price, often used to stabilize cost for certain commodities. It used to be an old-fashioned way of handling standard cost in earlier AX versions. Currently, it's simpler to just use standard cost models rather than this. Post-physical financial inventory to ledger should be kept enabled as a best practice. This ensures that inventory transactions hit the ledger at both the physical stage as well as the financial stage. Accrue liability on product receipt should be kept on as it creates a GRNI entry. It's also required under the GAAP and the IFRS principles. And lastly, physical and financial negative inventory is a critical one. Allowing negatives can cause costing issues, on-hand inventory issues. So it's generally best to disable physical negative inventory so that physical negative inventory in system always reflects reality. Next up is one of the another key configurations, item dimension group. These item dimension groups are attached to every inventory item when we set up our items, and the costs are tracked based on the enabled item dimensions. If you pay attention to the slide that I'm showing, businesses can decide which storage and tracking dimensions must be tracked financially. Financial inventory for site will always be turned on by default. But for instance, if financial inventory checkbox is turned on for warehouse, then cost for each warehouse is tracked separately. Similarly, if financial inventory is enabled for serial numbers, then costs will be tracked for each individual serial number. So there are pros and cons of enabling financial inventory at other than the site level, and this should be carefully set up. Now let's deep dive into the inventory costing models. There are periodic costing methods such as first in, first out, or FIFO, where the issue transactions are posted using the running average cost of an on-hand inventory. However, final issue cost is only updated when an inventory close or recalculation is run. Inventory closing finalizes adjustments and creates settlements according to the model principles. In perpetual costing methods, however, transactions post at a cost based on the cost model and do not get adjusted. Inventory close does not make any adjustments, but can still be run as it prevents any backdating of transactions. Discrepancies are posted to a designated account between posted costs and actual costs. We'll understand all this in some more detail in the next few slides. First in, first out, or FIFO, assumes the oldest inventory is consumed first. When you sell or issue stock, the cost is drawn from the earliest or first in purchase price on hand. System records temporary cost based on the running average cost until the inventory close process is run. As a result of inventory closing, the system settles issue transactions to the oldest available receipt transactions in that order. Using FIFO can result in older costs being matched against current revenues, which may increase reported profit when costs are rising. This method aligns with many real-world scenarios for perishable or time-sensitive goods, ensuring older stock is used before newer stock. There is a way in D365 FO that lets you override periodic costing, and it is known as marking. Marking is a manual process that lets you link or mark an issue transaction to a receipt transaction. As you can see on your screen, the variations of receipt from uh, the variations in matching receipts and issues from FIFO into marking. When a receipt transaction is marked to an issue transaction, the valuation method that is defined in the item model group is disregarded, and the system settles these transactions to each other. For example, if you have accepted a rush order from an important customer, and because this order is a rush order, you incur more cost to procure this item to then fulfill your customer's request. You want to make sure that the high cost of the inventory item is reflected in the margin or in the COGS for the sale you made. Last in, first out, or LIFO assumes the newest inventory layers are consumed first. Issues are valued at the most recent purchase costs so that the last items received are the first to be issued or sold. At period end close, the most recent costs are applied to issues. The older costs remain in inventory until those layers are consumed. One thing to note, however, LIFO is not generally allowed under IFRS, so its use is typically restricted to the local GAAP rules unless you have an audited or specific business requirement. LIFO date again is a variation of LIFO where issues are matched to the latest receipts as of specific date. In practical terms, it means the system looks at the last purchase up to the date of issue and uses that cost for the issue transaction. During the inventory close, transactions are settled, such as each issue is matched with the most recent prior receipt by date. So it's remembering by date is very important here, rather than the calendar period, which we saw earlier, like in FIFO or LIFO. This provides a more granular cost flow than the standard LIFO. Weighted average costing computes an average unit cost for all units in the inventory. Issues are valued at this average cost within a period, typically a calendar month. And inventory closing is needed to settle and finalize a single weighted average cost for all issues in the period. Prior to the inventory close, D365 will use a running average. After the close, all issue transactions for the period are adjusted to the true average of all receipt transactions in that period. Again, weighted average date is a refinement on the weighted average method that calculates a new average for each relevant date. The issues are valued at average cost of receipts for that particular day. After the inventory close, all transactions are grouped by day and settlement happens against that day's receipt to compute daily issue cost. This method is useful when you want inventory costs to reflect more immediate daily price fluctuations while still averaging within that day. So I'm putting that emphasis on the date or day word. For example, if prices vary widely in a day, weighted average date will reset the average price for that day. That way it's more granular and less variable. Moving average is a real-time average costing method. Moving average updates the item cost after each receipt transaction, continuously recalculating the average unit cost on hand. Each time a new inventory is acquired, the new cost is blended with the existing inventory value to produce a new moving average cost immediately. All subsequent issues use that updated cost. Importantly, no inventory close is needed for moving average. The cost of inventory and COGS is always up to date after each transaction. Running average inventory is nothing but moving average without the inventory closing requirements. So here is a quick comparison between the three average costing models in D365 FO because these are quite popular. Weighted average is a periodic method where costs are smooth across entire period. All issues in that period will share the same average and final adjustments are made at inventory close. It's useful when transaction volumes are low and when businesses want stability rather than volatility in the costs. Weighted average date, which is still periodic, it resets daily. All issues on the same day share the same average and closing adjusts those values. There's a good balance between smoothing and accuracy. It's often chosen by commodity-based businesses where backdating and corrections are very common, since it allows adjustments while still keeping day-level granularity. Finally, we have moving average, which is perpetual. Each receipt updates the cost immediately, and each transaction can have a different issue cost. There is no inventory close needed here. It's idle for high volume, fast turn industries like distribution or retail. It will mimic the purchase receipting volatility in issues, and errors in receipts cannot be corrected retroactively, however. So when choosing a costing model, the key consideration is how smooth or how granular you want your costs to be and how important accuracy versus stability is for your business. Next up, standard costing. Standard costing uses a predetermined fixed cost per item as the inventory value instead of the actual purchase cost for each batch. Every time every item has an active standard cost that the system uses for all inventory transactions. When inventory is received or produced, it is valued at this standard cost. When it is issued or sold, COGS is also at that standard cost. Any difference between actual cost and the standard cost is booked to a variance account. For example, if standard cost is of a part is $4, but if you purchase it for $6, the extra $2 is posted as a variance expense. So the inventory still capitalizes at $4. Now let's see all of this in action. I have posted some purchase and sales transactions to illustrate these costing models. The illustration will also show you what happens before and after inventory close. Let's first understand the before inventory close transactions scenario. System uses receipt cost to compute a running average cost, which is then applied to the issue transactions. The top and bottom sections compare transaction costs before and after inventory close. You may pay attention to the highlights in color as well. We start on 1st of July with a purchase of 100 units at $102 each. That sets our running average cost at $102 per unit. On the 10th of July, we sell 50 units and the system uses the same average cost of 102 to value the sale. Then on 15th of July, we make a new purchase of 100 units at $153. At this point, system recalculates the running average by dividing the total inventory value by the total units on hand. The cost gets updated to $136 per unit. On 30th of July, we sell another 100 units, and this time the system uses the updated average of 136 for valuation. On 1st August, we buy 80 units at 183. That's when the system updates the average cost to roughly about $165. But because no issues happen right away, this new cost just sits there. 5th August, we purchase 40 more units at $204. This pushes the average cost to 174.40. The same day, we sell 120 units and the system applies the last updated average cost for the valuation. Finally, on 8th August, another sale of 30 units go out. And once again, it's valued using the last known average cost of $174.40. Now, post inventory recalculation or close, the FIFO rule will kick in and match the first receipts with the first issues. The value of first 50 units do not change. Issue value for the next 100 units is updated as per the calculation. 50 is drawn from the first purchase lot and at the price of 102 and remaining 50 at the next purchase price of 153. Likewise, the rest of the issue values will follow. As you can see, system has revalued the posted issue transactions as per the highlighted. And thus there will be a variation in the before and after COGS. There is a slight variation. It's a rising price scenario. So you can see a slight variation after the inventory close. Next up is LIFO with the last in first out. The transactions before inventory close remain the same as we just saw in FIFO. However, after inventory close, system revalues the issue transactions based on the LIFO principle. So let's quickly go through the sequence. If you notice, the system picked up the last posted purchase cost of $204 for the first 40 units sold, and then blended it with the second last purchase price of $183 for the remaining 10 units. The same logic continues with the next sale of 100 units. The system first consumed the balance left at 183.6 rate and then blended it with the next available purchase cost in reverse order. For the following sale of 120 units, the principle is applied again. Here 70 units is taken at 153 and the remaining 50 units were at 102, which was the earliest purchase price. And finally, the sale of 30 units also went out at the 102 rate. So as you saw under LIFO, system use purchase costs in reverse order, starting from the most recent purchases and moving backwards. In a scenario where purchase prices are rising, this will result in a higher cost of goods sale, COGS, compared to FIFO because later higher costs are applied first. LIFO date, the issue valuation is tied to the specific date on which transactions occur. On 1st July, there was one purchase price updated at $102 when 50 units were sold that day. The system used this cost as the issue value. On 15th July, another sale of 100 units took place. Here, the purchase price update from the same date was used to value the issue. The important point is that the system always prioritizes price updates on that specific date. And same is true with the weighted average date as well. On 5th of August, we sold 120 units. The system first consumed 40 units from the same day's purchase price and then crossed into the previous boundary using 80 units at 183.6 from the last purchase update on the 1st of August. And finally, on 8th August, we sold 30 units. At this point, since the more recent cost had been exhausted, the system went back and picked up the earliest purchase price available to complete the valuation. Next is weighted average. In this method, system calculates the weighted average cost by dividing the total purchase value by the total units purchased in our example, and it works out to be about $151 per unit. Once this average is determined, the system uses it to value all issue transactions. For example, in the first sale of 50 units, you notice that how the sales value changed from 5,100 to about 7,500 on your extreme right, if you see the highlights. After the revaluation, similarly, all subsequent sales are valued using the same average cost of $151. The key observation here is that under weighted average, every issue gets the same issue cost regardless of the specific purchase cost. You will also note that this approach changes the COGS amount before and after inventory close, since system aligns everything to the calculated average. So the COGS cost we saw earlier in detail when we discussed FIFO, but with one important distinction: the issue costs are never revalued. System calculates the average cost in real-time basis and locks the average cost in when an issue, sale, or consumption is posted. Unlike other methods such as FIFO or LIFO or weighted average, there is no inventory close adjustments to revalue these issue transactions later. However, the moving average cost of a product can be adjusted, but such adjustments cannot be backdated. In this example, I have used the revaluation of moving average functionality to reduce the unit cost of an item from 174 to 150. As a result, both of the financial cost amount and the cost price of the items of the item were updated to reflect this new value. So if you look at the on-hand cost price, before the adjustments was $174, and I've just taken a snapshot of after the adjustments, it becomes 150. The adjustment also flows through the inventory transactions. So these are the inventory transactions. At the same time, an adjustment voucher is automatically posted. The difference in value between the old cost and the new cost is transferred to the moving average revaluation account. If you see here, a voucher got posted. In this case, that means the system debited the revaluation account as an adjustment disposal and credited the inventory to balance the change. This slide shows an inventory KPI that reflects the end-to-end cycle of procurement and sales for the item we just saw under moving average costing. From the statement, you can see that we procured around 320 units with a total value of 48,348. So if you bring your focus here. And then we sold 300 units valued at 45,348. The previously posted adjustments of 488 is also captured here as a value disposal or expense. You see here. And the month-wise breakup of this inventory turnover is also shown graphically. I've taken some snapshots in time and I've posted these square boxes over here. In July, we had some procurement and sales. So if you look at here, we had some procurement and sales in July, leaving us with an ending balance that got carried forward in August. The opening balance from July rolled in, and then we again saw some fresh procurement and sales within that month. So this gives us an understanding of how moving average costs flow across procurement, sales, and adjustments in a single view. We have another inventory, a very important inventory report called inventory value report or inventory value report storage, which is available in the system. And it also shows you the details of underlying transactions. For example, beginning balance, what happens during the time frame, and then what happens at the end. Now let's talk about the standard cost. Looking at this example, the standard cost for our item has been defined at $102. This means whenever we purchase or sell the value of the transaction will be at 102 per unit. For instance, system has valued the issue transactions at $102. All the purchases have been posted at standard 102 rate as well, even though the supplier prices were different. And the difference between the actual purchase price and the standard cost has been recorded as a purchase price variance, which will flow into the profit and loss statement. If you look at the various analysis statement on this slide, you can see since the actual purchase cost was higher than the standard, the system posted a variance of about $15,000. This variance doesn't change the inventory value on the balance sheet. It instead is taken to P&L where it directly affects the profitability. This method is especially useful in manufacturing industries where management wants stability in inventory valuation and better visibility of cost deviations through variance reporting. So now that we have gone through the mechanics of different costing methods, the key question is, how do you choose the right one for your business? Well, that's an exercise of understanding what your business does, analyzing processes, etc., and then recommending the most suitable ones. FIFO, just a summary, FIFO is best suited for industries with stable costs of perishable items such as food, pharmaceuticals. Weighted average works well when the cost fluctuates frequently and when you're or when you're dealing with the mixed inventory. LIFO is rarely recommended as of today, unless you have a very strong business justification. If you're dealing with commodities or if you want to reduce a taxable income in an inflationary period, then probably you can get an approval from the tax authorities for this. Moving average is a good fit for distribution and retail scenarios where items move quickly and costs need to stay current. Standard cost is ideal when the priority is tight cost control. This makes it very effective for manufacturing environments that want consistency and visibility into the cost deviations. So the key takeaway here is there is obviously no one size fits all method. You need to select the costing approach that aligns with your industry, product characteristics, and the regulatory requirements. Businesses often face recurring challenges if things are not set up correctly in D365 FO or if the best practices are not followed. So now let's understand some of these. The top challenges are many users misunderstand the difference between physical costs and financial costs. This often creates confusion in the inventory reconciliation, especially when transactions are partially updated. Another common issue is choosing a costing method that doesn't match the business model. Some businesses fail to run inventory close process on time. This delay leads to inaccurate financial reporting and misaligned COGS, etc. Businesses face valuation discrepancies because negative inventory is not configured or controlled properly. And last but not the least, failing to mark financial inventory dimensions correctly results in mismatches between inventory tracking and costing. And this causes a lot of cost reconciliation headaches across warehouses, sites, or product variants. So what measures can be taken to mitigate such challenges? Let's look at some of the do's and don'ts of best practices in FinOps. So the best practice do's are, if you're using a periodic model, then running inventory close is mandatory. Running recalculation is optional, though it can be run as a nightly batch. Inventory close process run must be executed per financial period defined in your ledger calendar, and it must be part of your month-end activities as well. Item model and dimension configurations must be planned carefully before you start using the system, because after transactions, changing configs or any reversals are generally complex or time-consuming. Remember to keep your accountants and auditors in loop when you take such decisions. Specifically in storage and tracking dimensions group, if you do not plan to segregate inventory costs across warehouses or in some special cases serial numbers, then you should not be switching on the financial inventory for them. Financial negative inventory must be allowed. Default item price or trade agreements must be set up to prevent $0 transactions. And the don'ts, best practice is to do right things the first time. So we recommend avoiding any changes to the core setups or be aware of what you're doing. Test thoroughly and take informed decisions. Avoid using fixed receipt price with a periodic costing model. Instead, just use the standard cost. It makes your life simpler. Avoid including physical value in cost calculation as it can distort inventory valuation and cost calculations unless you have a strong business reason to do so. Again, do not enable financial inventory on unnecessary dimensions like batches or serials. You should be very careful and mindful of that. And the most important of all don'ts is avoid enabling physical negative inventory. We have seen many problems because of this. The inventory value in your balance sheet and the cost of goods sold in your profit and loss statement can be understated. also using negative inventory with your running average or moving average can cause future calculations to be inaccurate.